Stop everything. What I'm about to tell you will change how you see money, banks, and your entire financial future. There is a hidden financial time bomb worth $600 trillion ticking beneath the global economy right now. Most people have never heard of it. Even Wall Street professionals can barely explain it. But when it detonates, and it will detonate, it will vaporize savings, collapse currencies, and plunge the world into an economic catastrophe that makes 2008 look like a minor inconvenience. Let me be crystal clear, this isn't conspiracy theory. This isn't exaggeration. This is documented fact buried in regulatory filings that nobody reads and financial statements that nobody understands. Warren Buffett, the Oracle of Omaha, the greatest investor of all time, called these instruments financial weapons of mass destruction back in 2003. He wasn't being dramatic. He was being precise. These weapons nearly obliterated the global banking system in 2008. They triggered the bankruptcy of Lehman Brothers. They required the $180 billion rescue of AG. They forced governments worldwide to commit $29 trillion just to prevent total economic annihilation. And here's the part that should terrify you. The response to that near-death experience was to dismantle these weapons. It wasn't to ban them or even reduce them. The response was to make them 10 times bigger. Today, this market is worth more than 6 times the entire global economy. Every stock, every bond, every piece of real estate. Every dollar, euro, and yen on planet Earth combined, and then multiply it by 6. That's how massive this bomb has become. When it explodes, there won't be enough money in existence to contain the blast. No government can bail it out. No central bank can print fast enough. No politician can negotiate a solution. The mathematics simply don't work. The fuse is already lit. The countdown has begun. And most people are completely unaware they're standing at ground zero. I'm going to show you exactly what this weapon is, how it grew so massive, why it's about to detonate,
and what the explosion will do to your life.
By the end of this video, you'll understand why 2025 isn't just another year. It's the year the entire financial system faces Judgment Day. Let's begin. Part 1. What are derivatives? To understand why we're facing financial Armageddon, you first need to understand what derivatives actually are, and I'm warning you, this gets dark fast. A derivative is a financial contract whose value derives from something else, an underlying asset. Sounds simple, right? It's not, because that something else can be literally anything. A stock price, a bond, a barrel of oil, an interest rate, a currency exchange rate, the weather, even whether a company will go bankrupt. Here rests the twisted part. You don't need to own any of these things to bet on them. Think about it like this. Imagine buying fire insurance on your neighbor's house. You don't own the house. You'll never live in it. But if it burns down, you collect a massive payout. That's essentially what a derivative is, a bet on something you don't own, don't control, and might not even understand. The most common types are futures, options, swaps, and forwards. Each sounds technical and boring until you realize they're being used to make absolutely insane leveraged bets with other people's money. A futures contract lets you gamble on the future price of commodities without actually buying the commodity. An option gives you the right to buy or sell something at a fixed price. It's a bet on a bet. A swap is an agreement to exchange cash flows, like trading fixed interest payments for variable ones. And forwards are private customized contracts between two parties to trade assets at future dates. Now here's where it gets dangerous. The financial industry claims these instruments exist for hedging risk. A farmer uses futures to lock in wheat prices. An airline hedges against rising fuel costs. A corporation manages currency exposure. All legitimate uses. But the derivatives market isn't dominated by farmers protecting their crops. It's dominated by massive banks making leveraged speculative bets with astronomical amounts of borrowed money. And the leverage is absolutely insane. Here's how the scam works. The notional value of a derivative is the face value of whatever you're rebetting on. But the actual money at risk is a tiny fraction of that. A bank might enter a $100 million interest rate swap but only put up $1 million in collateral. That's 100-to-1 leverage. Let me translate that. If the bet moves just 1% in the wrong direction, the entire collateral is wiped out. If it moves 2%, the bank now owes money it doesn't have. Multiply this by thousands of contracts across dozens of interconnected banks, and you've created a system where a small market hiccup triggers total collapse. But it gets worse. Modern derivatives are so impossibly complex that even the PhDs who designed them can't predict how they'll behave under stress. Credit default swaps, one of the weapons that destroyed the system in 2008, were sold as insurance against bond defaults. In reality, they became casino chips where gamblers who didn't even own bonds could bet billions on whether those bonds would fail. AIG, one of the world's largest insurance companies, sold hundreds of billions worth of these swaps without setting aside enough money to actually pay if things went wrong. When the housing market imploded, AIG suddenly owed more money than existed in its vaults. The US government had to inject $180 billion to prevent AIG from taking every major bank in America down with it. Here's what makes this absolutely terrifying. Derivatives create counterparty risk that spreads like a plague. If Bank A owes Bank B money on a derivative and Bank A collapses, Bank B doesn't get paid. Now, Bank B can't pay Bank C can't pay Bank D. The dominoes fall in hours, not weeks. That's exactly what happened when Lehman Brothers went bankrupt in September 2008. Lehman had over $35 trillion in derivative exposure. When it failed, every institution that had traded with Lehman faced instant losses they never saw coming. Some couldn't absorb the shock and needed emergency rescues. Others survived but stopped trusting anyone, freezing all credit markets and turning a banking crisis into a global economic meltdown. The lesson from 2008 should have been obvious. Ban these weapons or severely restrict them, especially the most toxic varieties like naked credit default, swaps where you rebetting on defaults of bonds you don't even own. Instead, regulators created some paperwork requirements and moved a fraction of derivatives to central clearinghouses. But they didn't reduce the total size of the market. They didn't ban the most dangerous instruments. They didn't eliminate the leverage. Banks lobbied hard, claiming derivatives were essential for managing risk and provided market liquidity. Regulators either believed the lies or were too corrupted by Wall Street money to act. The result? The derivatives market didn't shrink after 2008. It exploded, growing from $60 trillion to over $600 trillion today. And now we're sitting on a bomb 10 times larger than the one that nearly ended civilization. Part 3. The $600 trillion monster. Today, the derivatives market in 2008 was about $60 trillion in notional value. Today, it exceeds $600 trillion, making it roughly 10 times larger than the crisis that nearly destroyed human civilization. Let me put that number in perspective so your brain can actually process it. Global GDP, every good and service produced on planet Earth in a year, is approximately $100 trillion. The derivatives market is 6 times the size of the entire world economy. If even 5% of those derivatives fail, that's $30 trillion in losses. That's 3 times the total cost of all the 2008 bailouts combined. There is no mechanism, no amount of money, and no policy tool in existence that could absorb losses of that magnitude without collapsing the entire global financial system. Let me be blunt. We're not talking about a recession. We're talking about the potential end of the modern monetary system. The composition of this market makes it even more dangerous. The largest category is interest rate derivatives, over $500 trillion of the total. These are bets on the direction and volatility of interest rates. Banks claim they use them to hedge exposure to rate changes. In reality, they use them to speculate with borrowed money. When rates are stable, these derivatives appear safe. But when rates move rapidly, as they have over the past 3 years, the risk multiplies exponentially. The Federal Reserve raised interest rates from near zero in 2021 to over 5% by 2023. That's the fastest rate hiking cycle in 40 years. Every single increase created massive winners and losers in the derivatives market. The losers accumulated enormous losses that are sitting on bank balance sheets right now, hidden by accounting tricks that allow banks to avoid marking positions to current market value. The second largest category is credit derivatives, about $50 trillion in notional value. These include credit default swaps, the exact same instruments that destroyed AIG and nearly took down the world. After 2008, regulators promised to clean up this market. They lied. Banks and hedge funds still use credit default swaps to bet on corporate and sovereign defaults. The difference now? Corporate debt has absolutely exploded. U.S. corporate debt alone grew from $2 trillion in 2008 to over $10 trillion today. Much of that debt was issued at artificially low interest rates that no longer exist. As companies try to refinance at current rates, many will default. When they do, the credit default swaps written on their debt will trigger massive payouts. If enough companies default simultaneously, the institutions that sold credit protection will face losses they absolutely cannot absorb. That's the AGA scenario replaying. Except this time, there's no Federal Reserve willing or able to print another $180 billion to bail out derivative gamblers. Currency derivatives represent another $100 trillion, and they're incredibly vulnerable to exchange rate shocks. The US dollar has been the world's reserve currency for 80 years, but that dominance is rapidly eroding. China, Russia, India, and other countries are increasingly conducting trade in their own currencies. Saudi Arabia is accepting yuan for oil instead of demanding dollars. If the dollar loses reserve currency status, or even weakens significantly, currency derivatives will experience violent, catastrophic moves. Banks that have based their entire risk models on dollar stability will suddenly find themselves on the wrong side of trillion-dollar bets. The unwinding would cascade through every market on Earth because currency movements affect literally everything: stocks, bonds, commodities, trade flows, government finances. But the most sinister aspect of modern derivatives is their mind-bending complexity. After 2008, did banks simplify their derivative positions to make them safer and more transparent? Of course not. They made them exponentially more complex by creating derivatives of derivatives of derivatives. You can now buy options on credit default swaps. You can trade swaps based on indexes of other swaps. This nesting creates layers of leverage, where a tiny movement in an underlying asset triggers massive explosions in the value of the derivative pyramid stacked on top. Nobody, and I mean absolutely nobody, not even the quantitative analysts and rocket scientists who design these products, can accurately model how they behave under extreme stress. The mathematical models assume normal market conditions, continuous liquidity, and counterparties that always pay their obligations. In a real crisis, none of those assumptions hold. Markets become completely illiquid. Prices gap violently without any trades in between. Counterparties fail and can't pay. That's when the models completely break down and losses exceed anything the risk managers predicted by orders of magnitude. The concentration of derivatives in a terrifyingly small number of institutions makes the fragility even worse. In the United States, just 4 banks hold approximately 90% of all derivative exposure: JP Morgan Chase, Citibank, Bank of America, and Goldman Sachs. JP Morgan alone has over $54 trillion in notional derivative exposure, roughly 180 times its total capital. Let me repeat that. JP Morgan's derivative bets are 180 times larger than the money it actually has. This concentration means if one of these banks miscalculates, the entire system implodes. There's no diversification. These biggest banks are all making nearly identical bets because they all responding to the same market signals and regulatory incentives. When everyone is positioned the same way, a shock in one direction creates simultaneous catastrophic losses across the entire system. That's not risk management. That's systemic fragility disguised as sophisticated finance. We're not talking about risk spread across thousands of institutions. We're talking about $600 trillion in bets concentrated in 4 banks that are all connected to each other through derivative contracts, creating a circular death spiral where if one fails, they all fail. Part 4. The 4 banks holding the bomb. The derivatives market isn't evenly distributed across the financial system. It's concentrated in 4 American megabanks that together hold over $500 trillion in notional exposure: JP Morgan Chase, Citibank, Bank of America, and Goldman Sachs. These are the exact same institutions that were bailed out in 2008, and now they're bigger, more leveraged, and more dangerous than ever before. Understanding how much risk they actually carrying requires looking beyond the notional values to the leverage ratios and the spiderweb of interconnections between them. JP Morgan Chase is the undisputed king of derivatives in America, holding approximately $54 trillion in notional exposure, according to the most recent regulatory filings. To put that in context, JP Morgan's total assets are about $3.7 trillion, and its equity capital is roughly $300 billion. That means JPMorgan's derivative exposure is 180 times its actual capital. The bank will tell you notional value overstates the risk because most positions are hedged, meaning they supposedly offset each other. JP Morgan claims its net current credit exposure from derivatives is only about $50 billion, a tiny fraction of notional. This sounds reassuring until you remember that's exactly what Lehman Brothers said before it vaporized. That's exactly what IG claimed before it needed $180 billion in taxpayer money. Their hedges worked perfectly, until they didn't. When counterparties fail or markets become illiquid, hedges disappear like smoke. Gross exposure becomes the only thing that matters. And JP Morgan's gross exposure could sink not just the bank, but the entire American economy. Citibank holds approximately $48 trillion in notional derivative exposure against total assets of $2.4 trillion and capital of about $200 billion. Bank of America holds roughly $37 trillion in derivatives against $3.1 trillion in assets and $280 billion in capital. Goldman Sachs, though smaller than the commercial banking giants, holds $47 trillion in derivatives against total assets of just $1.6 trillion and capital of $120 billion. Add these together. Four institutions are carrying about $186 trillion in derivative exposure. That's nearly double the entire global economy. If any one of these banks makes a catastrophic error in managing these positions, the losses could exceed the bank's capital many times over, rendering it instantly insolvent. The standard defense is that these are sophisticated institutions with advanced risk management systems, armies of quantitative analysts, and regulatory oversight. But sophistication doesn't prevent disaster. It enables it. Complex risk models create false confidence, encouraging banks to take positions larger than any simple analysis would justify. Remember long-term capital management? The hedge fund that collapsed in 1998 had two Nobel Prize-winning economists on staff and employed the most sophisticated mathematical models in finance. It still lost $4.6 billion in 4 months and required $3.6 billion Australian dollars Federal Reserve arranged bailout because its failure threatened the entire system. LTCM's derivative exposure at the time was $1.25 trillion, an absolute joke compared to what the big four banks hold today. The interconnection between these banks creates a web of circular dependencies where each bank's survival depends on all the others remaining solvent. JP Morgan might hedge its interest rate exposure by entering swaps with Citibank. Citibank might hedge with Bank of America. Bank of America might hedge with Goldman Sachs. Goldman might hedge back with JP Morgan. On paper, the positions look balanced. In reality, it's a circular firing squad. If one bank fails, the others suddenly face massive losses on their supposedly hedged positions. This was the exact dynamic in 2008 that turned Lehman's collapse into a systemic apocalypse. The central clearing requirement imposed after 2008 was supposed to solve this by having clearinghouses stand between buyers and sellers, guaranteeing both sides of every trade. But clearing only covers standardized derivatives traded on exchanges. The vast majority of the $600 trillion market consists of over-the-counter derivatives, customized contracts negotiated directly between banks that aren't centrally cleared at all. These bilateral contracts still create the same counterparty risks that existed in 2008. Even the cleared derivatives create systemic risk because the clearinghouses themselves have become too big to fail. If a major clearinghouse faces losses exceeding its default fund, it could collapse, taking all member banks down with it. The largest clearinghouses have rules allowing them to tear up contracts or forcibly allocate losses to surviving members in a crisis. Translation: if enough banks fail, the clearinghouse can essentially confiscate assets from banks that managed risk responsibly to cover losses from banks that gambled recklessly. This mutualizes risk in a way that actually discourages prudent behavior. Why manage risk carefully when you'll be forced to pay for other banks' failures anyway? The derivatives market has survived 15 years since 2008 without another catastrophic blowup. which has created a dangerous illusion that reforms worked and risks are under control. But survival isn't stability. The market has remained intact only because we've been living through a historically unusual period: ultra-low interest rates, minimal volatility, and central banks intervening every time markets showed even slight stress. That era is over. Finished. Dead. The triggers that will cause the next derivatives crisis are already activating, and several will likely detonate over the next 12 to 18 months. Part 6. Why there's nitrogen monoxide bailout coming, the most terrifying aspect of the dollar. 600 trillion derivatives market is this simple truth. When it fails, there is no bailout large enough to stop the cascade. None. The mathematics don't work. In 2008, governments and central banks committed approximately $29 trillion globally to prevent complete collapse. That was roughly 40% of global GDP at the time. It required every major government to coordinate unprecedented action, every central bank to print money simultaneously, and every political system to accept measures that would have been considered impossible just months earlier. It worked, barely. And it caused a decade of economic weakness, exploding government debts, the worst inequality in modern history, and the political upheavals we're still experiencing today. The derivatives market today is $600 trillion in notional value. If just 10% goes bad, that's $60 trillion in losses, more than twice what was required to stop the 2008 crisis and more than half of total global GDP. Governments don't have $60 trillion. They're already drowning in debt from COVID spending, prior bailouts, and demographic pressures crushing social programs. U.S. government debt is $36 trillion. European governments are similarly leveraged. Japan is beyond hopeless at 260% debt to GDP. China claims lower official debt, but has massive hidden obligations. None of these governments can borrow another $10, $20, or $60 trillion to bail out derivative traders. The bond markets would collapse immediately from the flood of new debt issuance. Central banks could theoretically print the money through quantitative easing, but that comes with catastrophic consequences. The Federal Reserve's balance sheet expanded from $800 billion before 2008 to $9 trillion at its peak during COVID. That money printing contributed directly to the inflation spike of 2021 to 2023, the worst in 40 years. If the Fed tried to print another $20 or $30 trillion to bail out derivatives losses, the resulting inflation would be absolutely catastrophic. The dollar would lose substantial value. Imported goods would become unaffordable. Real wages would collapse. Social unrest would explode. At some point, printing money to save the financial system destroys the currency itself. And a currency crisis is far worse than a financial crisis because it affects everyone. Not just investors and banks, but every person trying to buy food and pay rent. The political will for another massive bailout also simply doesn't exist anymore. In 2008, the public was shocked but ultimately compliant. The government told them the banks had to be saved or the entire economy would collapse, and most people reluctantly accepted it even though they hated every second. That acceptance is completely gone. The past 15 years prove that bailouts saved banks but did nothing for ordinary people. Wages stagnated. Housing became unaffordable for an entire generation. Wealth inequality exploded to levels not seen since the robber baron era. The next crisis will arrive at a time when trust in institutions is at all-time lows. Political polarization is extreme, and populist movements on both left and right are demanding that the wealthy pay for their own failures. If governments try to bail out banks again, they'll face resistance that could escalate to ungovernable social unrest. The too big to fail doctrine that justified the 2008 bailouts has now transformed into too big to save. The banks are larger, more leveraged, and more interconnected than they were in 2008. Their derivative books are 10 times bigger. Their balance sheets are more complex. Their global reach means a failure anywhere instantly propagates everywhere. And the resources available to save them, government borrowing capacity, central bank credibility, political legitimacy, are all dramatically diminished from 15 years ago. The system has grown far beyond the ability of any institution or government to rescue it. There is also a fundamental mathematical problem with bailing out derivatives that didn't exist with traditional bank assets. When a bank holds bad mortgage, the government can buy them, absorb the loss, and eventually recover some value when the housing market stabilizes. It's expensive but comprehensible. Derivatives aren't assets. They're contracts between parties. When a derivative fails, one side loses money and the other side wins money. If the government bails out the loser, it's simply transferring wealth to the winner for absolutely no productive economic purpose. There's no underlying asset that could eventually recover value. It's pure speculation, and bailing out speculators with taxpayer money makes no economic or political sense whatsoever. Furthermore, the sheer opacity of the derivatives market makes it literally impossible to even determine who should be bailed out and for how much. When Lehman failed, it took months to unwind the derivative book and figure out who owed what to whom. In a true systemic crisis where multiple major institutions fail simultaneously, the tangled web of offsetting contracts, bilateral negotiations, and complex netting agreements would take years to sort out. By the time anyone figured out the true losses, the real economy would already be in a multi-year depression. You cannot bail out a system you cannot even understand. The only rational policy response would be to let the losses fall where they may allow insolvent institutions to fail and deal with the economic consequences directly rather than trying to prop up a system that has become fundamentally irreversibly unsustainable. That would mean widespread bank failures, massive pension fund losses, devastating unemployment, and a severe recession or depression lasting years. It would be absolutely catastrophic. But attempting to bail out $600 trillion in derivatives would be even worse because it would add currency collapse and potential hyperinflation to the list of disasters while not actually solving the underlying problem. The bomb is too big to defuse. When it explodes, we all get hit by the shrapnel. The inevitable detonation, so here we are, sitting on top of a $600 trillion derivatives market that's 10 times larger than the one that nearly destroyed civilization in 2008, held primarily by 4 megabanks whose simultaneous failure would end the modern financial system as we know it, facing multiple triggers that will likely activate over the next 12 to 18 months, with absolutely no ability to bail it out when it goes catastrophically wrong. Warren Buffett called derivatives financial weapons of mass destruction back in 2003, and he's been proven correct over and over and over again. The response hasn't been to disarm these weapons. It's been to build them bigger, more complex, and more deadly. The crisis is coming. It's not a question of if anymore. It's only a question of when and how bad. It might start with interest rate volatility as the Federal Reserve flip-flops between fighting inflation and preventing economic collapse. It might start with commercial real estate defaults cascading through credit derivatives like a wildfire. It might start with a European banking failure or a Japanese debt crisis or the implosion of China's real estate sector. The specific trigger almost doesn't matter at this point because the system is so incredibly fragile that any significant shock will blow it into pieces. When one major bank can't meet its derivative obligations, the cascade begins instantly. Counterparties discover their carefully constructed hedges don't actually work. Margin calls force panic selling. Central clearinghouses face losses that threaten their own solvency. Within hours, not days, not weeks, but hours, every major financial institution in the world is facing losses it absolutely cannot absorb. Governments will announce emergency measures. The Federal Reserve will create new lending facilities. Central banks will coordinate desperate interventions. Politicians will make solemn speeches about protecting the system and maintaining stability. None of it will work. Not because policymakers are incompetent, but because the problem is simply too enormous. The mathematics don't work. You cannot bail out losses that exceed half of global GDP. You cannot print enough money without destroying the currency. You cannot negotiate enough debt forgiveness to make insolvent banks solvent again. The numbers are too big. The system is too complex. The interconnections are too dense. It's beyond saving. What comes after the derivatives market explodes is genuinely unknowable because we've never witnessed a financial crisis on this scale in modern history. The Great Depression was economically devastating, but it unfolded gradually over years, giving people and institutions time to adjust and adapt. A derivatives cascade would unfold in days or weeks, moving faster than any policy response could possibly follow. Bank accounts would freeze as institutions went into receivership. Credit cards would stop working, ATMs would run dry. Pension funds would show losses so catastrophically large that retirement becomes impossible for tens of millions of people. The economic disruption would create severe social chaos as supply chains shattered and unemployment spiked to levels not seen since the 1930s. We're not talking about a recession where GDP shrinks by 2 to 3%. We're talking about a potential depression where economic activity collapses by 20, 30, maybe 40%. This isn't speculation. This isn't doom prophecy or conspiracy theory. This is pattern recognition and basic mathematics applied to publicly available data. A market that was $60 trillion destroyed the global economy in 2008, despite the largest coordinated bailout in human history. That same market is now $600 trillion, 10 times larger. The bailout capacity is gone. Government debt is maxed out. Political will is exhausted. Central bank credibility is shattered. The triggers are appearing right now in real time. The cascade is inevitable. The only remaining questions are precise timing and exact magnitude. And the answer is almost certainly sooner and larger than almost anyone expects. Because throughout history, every time humans have created a financial weapon of mass destruction, it has eventually been detonated. Derivatives are no different. The fuse is burning. The countdown has begun. And when this bomb explodes, the blast will be felt by every person on Earth. If this video opened your eyes to the danger we're all facing, you need to share it. People deserve to know what's coming. They deserve to understand why their savings, their pensions, their entire financial future is at risk. Subscribe to this channel because in the coming months, I'll be tracking every development, every trigger, every sign that the detonation is imminent. You need to be prepared for what's coming. The $600 trillion bomb is real. It's armed. And the timer is running out. I'll see you in the next one. If there is a next one.